Good afternoon, everyone, and welcome to the Fiscal Philosophy YouTube channel. What even is this market this year? We're doing the thing so far that I kind of thought we might do. My gut was telling me near the end of last year that 2025 would probably be quite rocky with a lot of volatility, and you see a lot of peaks and valleys. But overall, yes, the market is down a little bit, at least the QQQ is about 1.7%, but with the way things have been going and people crying wolf and saying the sky is falling, you would think it's down like 15-20% on what the sort of mentality is out there right now. So at the moment, I'm personally feeling a little bit of pain on names like Amazon, for example, that are big in the QQQ. But personally, I'm not too terribly alarmed. And heck, today the market, for whatever reason in my account, are heavily in the green. Go figure. Now, why is it that this market is crashing narrative is so prevalent in spite of the fact that the QQQ even is only down a little bit under 2% right now for the year? Well, it's because high beta names are leading the charge in this latest sell-off. You look at a company like Hims. It hit a peak of around $70 a share, something like that. And now it's fallen back down to in the 40 range. That's quite a big dip. And it's funny because around that area where it was peaking, somewhere between $60 and $70 a share, we had Capital Mindset on the Cash Flow Kings live show that weekend, and he had informed us that he was doing some stuff to essentially short beta, meaning high beta stocks. And what we mean by high beta is, generally speaking, the more beta above 1, the more volatile it is compared to the market. Like a 1.0 I think is considered kind of like just like average, and lower means it moves less than the market. So you might have like consumer staples like Coca-Cola and some stuff like that might have lower beta than 1. And then higher tends to be the stuff like the retail high flyers, your Hims and Hers, your Palantirs, or things that are maybe like had some really bad news or excessively shorted, things like medical properties trust that I'm in, that might show a higher beta because for the last couple years it's been extremely volatile. Beta is just a measure of how volatile the stock is compared to like the overall market. So at the moment, for the most part, high beta, and the higher the beta, generally speaking, it seems like the worse it has been, have been the ones that have been getting punished the most recently. However, like even some of these names on like a year-to-date basis are actually still doing quite well. The regards, as they say, have come and have not all given up yet. But absolutely, this other idea came up on the show, and that is that what we call the crappy co's or the ish co's, got to keep it family friendly. Those ones will actually probably just continue on down into nothing. The ones where there's an actual decent business behind them, the peaks we may not actually see again for a while. Like the sell-off into a more reasonable valuation may stick for a lot of those, but the ones that actually have good businesses behind them, certainly we wouldn't expect them to go to zero. But the ones without, the weak hands will let them go, and then there will be capitulation. And if they're in a really bad financial situation, they won't be able to issue shares their way out of it. Like I look at something like an Oatly or something might be in pretty bad straits at the moment. Let's look at another practical example in my portfolio. We have Amazon, which it has a beta above 1 and has been one of the harder hit stocks in this recent sell-off that we've had in a lot of the big QQQ names. Now, when we see a slightly higher beta. It feels great on green days when you're beating the market, right? But when you're having those red days and this is leading your losses, it doesn't feel as great. However, my cost basis on this is below 180, and it's not an unreasonable valuation for a company like Amazon. Their operating cash flows are immense and keep growing. Yes, there's a lot of CapEx, but that's always been the story with Amazon. If you didn't hate the CapEx back in the days when their operating cash flows were lower and they didn't even have positive earnings or positive free cash flow, you shouldn't mind their CapEx today when they have shown that they know how to deploy that money in a wise and value creating kind of way. So what I would say is if you missed that drop from like 200 to 160 that we had last year when I was accumulating, this might be, this could potentially be viewed as a strategic entry point because Amazon has only gotten stronger, improved their financials more over that period of time. And as the fundamentals improve and the market is forward looking, if you can anticipate that they will continue to improve into the future, that actually raises the value of the stock. That's how things work. So I personally think that this is possibly a good entry point at this point in time on Amazon. Although, hey, with the way things have been going lately, you might get another pullback. I mean, I think just the other day, it actually did touch just below 200 for a second. So there's nothing wrong with putting some cash on the sidelines and waiting on something like this. But if you were on the fence about Amazon at any point, and then you missed that run up to 242, I would view this recent pullback as maybe a gift, and maybe, the universe giving you your second shot to get like a reasonable price on Amazon. Granted, I don't think it's going to like 5x or anything, but I do think you can get like a solid like 15-20% on this stock for sure over the, CAGR over the next few years. I think that they've still got that much left in them for sure. Also, another practical example of from my portfolio of a company that hasn't gone completely down in the dumps so far this year. Now, they had a big earnings run up and a bit of a sell-off because I think the earnings wasn't absolutely tremendous, but it's had a little bit of a kind of a recovery since that earnings pullback. And on the year, and this is pretty early 2025, it's positive 9.21%, plus we will get dividends on this. And the beta is only about 0.26 here, meaning this stock does not move very fast price-wise, usually. So why would this stock be performing year-to-date, at least, better than something like Amazon? Well, when people are scared, volatility seems a lot like uncertainty in the business because, hey, those pullbacks, they're very frightening, and people tend to flee to stability, which seems a lot like safety. Now, I don't necessarily think that British American Tobacco is like a safer business model than Amazon. They're both wide moat businesses, to tell the truth. And now British American Tobacco has some regulatory risks, and certainly smoking populations in Western countries are declining. Amazon also, has potentially been a target of some antitrust type stuff. People think they're a monopoly. You get calls to break them up. There's a lot of bad press around, their drivers. There's talks of unionization. Like, there's risks with Amazon too. Now, BTI has been around a long time, pays out a pretty big dividend, and so therefore directly returns cash to shareholders, and just seems very steady Eddie, very stable. And when people are feeling uneasy, this is just the kind of thing they gravitate towards. I think a lot of it is psychological, those flight to safety type situations. They don't expect this to 10x, but like they do with, a lot of tech names, but they do expect like, hey, it's probably not gonna like drop in half on a whim, and it's gonna pay you a dividend in the meanwhile. Feels very cozy and comfy. Whereas Amazon is still, it's a tech high flyer, and who knows what the future is? Maybe chat GPT, large language models, quantum computing, the blockchain, all that. Maybe it's all bad and it's going to cause them to crumble and they're going to get disrupted. I don't know. That's just the kind of stuff you hear from people. I mean, I had somebody on Twitter talking about a bear case for Google that had to do with Canadian oil tariffs. Like, people will just look for any reason to be fearful in times where things are, a bit wonky in the market. And I try not to take a too emotional a perspective on it. I look at, what are these businesses? Do I see them being as strong or stronger tomorrow than today? Is the sell-off actually warranted? And for the most part, I don't worry too terribly much about what I hold. Now, we're going to get to like the actual worst performer during this period. Okay, so what has felt, at least, the most difficult to hold during this period of volatility? For me, it's been TSSI. Now, after I initially bought it in the beginning of January, I had a nice run up to like $17 a share or something like that, which was cool. But then, we had a pullback, another run up, a little mini pullback, another run up, and now we've had a really big pullback. But all in all, it's not that bad. I mean, it's kind of bad, but it's not that bad. However, I'm surprised to see that it's only got a 0.79 beta, but there's a lot of other factors as to why this name specifically would be getting hit. One is it's kind of a sympathy thing to big tech, because people are skeptical now of the AI data center, etc. spending and the capex from like Microsoft and other big names. And this company is, at least for the bulls, the people that own shares that are long, the expectation is that they would receive some of that capex spend and receive revenue from that, and it would drive up their revenue and their EPS accordingly. If that does not happen, which that's what people are now worried about, well, then yeah, it wouldn't be good for this company. However, I didn't hear anything about companies specifically stating that they were going to pull back on their their capex in these areas. I know Microsoft was supposed to be spending something on the order of $80 billion this year, and others are likewise spending pretty substantial amounts. And the belief is that this company has contracts that they're able to depend on from Dell due to their CEO's close connections and former employment at Dell. So at the moment, it seems like the overall like case for this stock is actually intact, but the big swath of retail stock shareholders on this stock are retail, and so they're liable to just sell hit that panic sell button the moment things start looking a little dicey. I'm not really all that emotional with my approach, or I try not to be, and until like I see a real reason to sell something, I'm hesitant to do so. Sometimes to my own detriment, maybe. Maybe my hands are a little too diamond in some cases, but I can't, like, I have to remember that I can't give in to just like my knee-jerk emotional reactions, or I'm just gonna be buying and selling all over the place for no real reason, and that's not, I don't think, the way to invest. So I'm still comfortable holding this, but I understand why people maybe are a little hesitant. Although, if you are a true believer in this name, this pullback back below $10 could be creating, again, what I would call a strategic entry point, though I would expect continued volatility for the moment, just because I don't know if we've seen the last of that, to be honest. I would love to get you all's takes on this market volatility. Have you seen any new opportunities open up? Did you see this coming and maybe like take some either flight to safety type positions, or perhaps even short beta like Capital Mindset was talking about? Also, make sure that you consider joining my Discord, linked in the description, if you want to talk about it further, though comments are welcome as well. And with that, I have a few parting remarks. If you have made it to the end, I would like to thank you and also invite you to like the video for the algorithm, subscribe to my channel. Like, once again, join the Discord link in the description. Also, my X account at Mr. Macho Mog. I am trying to build an audience there. It's not going all that well. It's pretty slow running, but I have fun on there. Make sure also that you catch me every Saturday, 8 p.m. Eastern on the Cashflow Kings Live. Consider becoming a member to support the channel directly, or sign up to our sponsor in the description, which is Moomoo. If you deposit a certain amount, you can get up to 30 free stocks, I am told, which is pretty exciting. When I signed up and deposited, I got shares of Grab, which is one of my favorite stocks, as you know. And hey, just keep the conversation open. Let me know what you think of this type of video where I talk a little bit about like the broader thing that's going on in the market and don't fully focus in on just one stock. Just trying something new. Take it easy, everybody.